stop. If you are scraping together a down payment right now thinking you are investing in your future, you are about to make the single most mathematically destructive decision of your life. I'm not trying to scare you. I'm looking at the spreadsheet. Right now in late 2025, the 30-year fixed mortgage rate is sitting at an aggressive 6.58%. Let's run the numbers on a standard $430,000 home. With a 20% down payment, your total monthly cost to own, factoring in taxes, insurance, that nagging HOA fee, and maintenance, is roughly $2,650. But renting that exact same property, it's currently trading for $2,550. Do the math. That is an immediate guaranteed loss of $400 every single month just for the privilege of holding a deed. For the first time in modern history, the old adage renting is throwing money away is dead wrong. In 2025, buying is the real money pit. But the $400 deficit is just the surface level trap. There is a deeper, invisible mechanism in the amortization schedule that drains your wealth even faster, and I'm going to break down exactly how it works. For decades, the American script was written in stone. Go to school, get a steady job, and buy a house. That was the ticket to the middle class. Your parents likely drilled this into you, telling you that renting is dead money and paying a mortgage is paying yourself. Here is the problem. They aren't lying to you, but they are operating on outdated software. They are giving you advice for an economy that ceased to exist in 2020. We are currently witnessing a historic fracture in the housing market, creating two distinct classes of citizens, the locked in and the locked out. Consider the context. For over a decade following the 2008 crash, we lived in an era of historically cheap money. This allowed millions of Americans to secure mortgages at rock-bottom rates. In fact, right now, nearly 48% of all mortgaged homes in the U.S. are locked in at rates under 4%. This created a massive distortion. These homeowners are effectively trapped in their own wealth. They cannot sell their homes because moving would mean trading a 3% rate for the current 6.58% reality. As a result, inventory has vanished. Nobody is selling, which keeps home prices near record highs despite the crushing interest rates. So if you feel like the game is rigged or like the ladder is being pulled up just as you reach for the bottom rung, you aren't crazy. You are reacting rationally to a market that has fundamentally broken its promise. The American dream of ownership has mutated into a financial trap for new entrants. But understanding the history isn't enough to save your wallet. You need to see the glitch in the system. Most people think a mortgage payment goes toward owning their home. But when we look at the amortization tables for 2025, we find a terrifying truth about where your money actually goes during the first 6 years. Let's put feelings, emotions, and societal pressure aside. We are going to look at the raw arithmetic of 2025. To make this concrete, we are using the latest data from Investopedia regarding the median American housing scenario. Let's build our case study around a standard, median-priced home valued at $430,000. To even play this game, you first need a down payment. Let's assume you are a disciplined saver and you put down a solid 20%. That is $86,000 in cash that you are locking away immediately. Now let's look at the monthly bleed. We are calculating this based on a 6.75% interest rate, which is the realistic rate for borrowers with good credit in this specific case study. Your principal and interest payment alone is roughly $2,231. But the sticker price is never the real price. When you add in property taxes, homeowners insurance, typical HOA fees, which are rising nationwide, and the critical 1% rule for maintenance, saving 1% of the home's value per year for repairs, the Investopedia analysis puts your total monthly cost to own at $2,150. Now let's look at the alternative. That same $430,000 house, or a comparable unit in the same neighborhood, rents for approximately $2,550 a month. This is the first strike, the monthly gap. Right out of the gate, the renter is keeping $400 more in their pocket every single month compared to the buyer. Now I know what you are thinking. I can hear the comment section already, but wait! The renter is burning that $2,550. The homeowner is paying themselves. That $2,050 is building equity. This is the most dangerous lie in real estate, and it persists because people do not understand amortization schedules. This is the glitch in the system I promised to explain. Mortgages are front-loaded with interest at a 6.75% rate. The math is brutal. In your first year of payments, you will send the bank roughly $26,000. Do you know how much of that actually pays down your debt? Only about $4,000. Read that again. You pay $26,000 and you gain $4,000 in equity. The other $22,000 is vaporized. It goes straight to the bank as interest profit. It is effectively rent you are paying to the bank to use their money. So when you compare the renter versus the buyer in year one, the renter threw away roughly $3,600 in rent. The buyer threw away $22,000 in interest, plus roughly $8,000 in taxes, insurance, and HOA fees, plus maintenance costs. The unrecoverable costs are almost identical. The buyer is not paying themselves. They are mostly paying the bank and the local government. But we are missing the biggest variable, that $86,000 down payment. The buyer locked that cash into the house walls. It is illiquid. It is doing nothing but sitting there. The renter, however, still has that $86,000. If the renter takes that $86,000 plus the $400 monthly savings they get from renting and invests it in a standard S&P 500 index fund, historically returning a 8 to 10%, the compound interest effect is staggering. While the homeowner is praying for their property value to appreciate fast enough to cover the interest rates, the renter's portfolio is growing exponentially without lifting a finger. This brings us to the break-even horizon, calculated by real estate expert Kirk Reagan. In the old days, 2015, 2020, it often made sense to buy if you planned to stay in a home for 3 years. Today, the math has shifted violently. Reagan's analysis shows that with current rates and prices, the break-even point, the moment where buying finally becomes financially superior to renting, is now pushed out to over 6 years. This means if you buy that house today and life happens, you get a new job offer in a different state, you get divorced, or you just want to move. Before the year 2031, you will likely lose money on the transaction. Why? Because selling a house costs money. Real estate agent fees, usually 6%, closing costs and transfer taxes will eat about 8 to 10% of your sale price. If you haven't built enough equity to cover those exit fees, you are writing a check at closing just to get out of the mortgage. So, the math for 2025 is clear. Unless you are willing to commit nearly a decade to one location, the security of ownership is mathematically a liability. But if the math is this obvious, why is everyone still obsessed with buying? Why do we feel like failures if we rent? That isn't economics, that is psychology. And that is the trap we need to dismantle next. If the math is so clearly against buying right now, why does it feel so wrong to rent? Why do you feel a pang of anxiety when you see a friend post a photo of a set of keys on Instagram? It's because you aren't battling a calculator. You are battling decades of psychological programming. We are suffering from a collective cultural hypnosis that equates homeownership with adulthood. In the American psyche, renting is viewed as a transitional phase, something you do when you're young, broke, or unstable. Buying, on the other hand, is branded as the finish line. It is the ultimate signal that you have made it. This is what psychologists call the normalcy bias. We assume that because buying a home was the correct path for our parents in 1990, and our older siblings in 2015, it must be the correct path for us in 2025. We refuse to accept that the fundamental conditions of the environment have changed, so we cling to the old script even when it leads us off a cliff. Then, there is the fear of missing out, or FOMO. This is perhaps the most dangerous driver in the current market. You look back at the last decade, and you see people who bought homes in 2019 doubling their net worth by doing absolutely nothing. You see the asset inflation that happened during the pandemic, and you are terrified that if you don't buy now, even at these exorbitant rates, you will be locked out of the asset class forever. You're buying out of panic, not logic. You're chasing the returns of the past, hoping they repeat in the future. In investing, that is the classic recipe for buying the top. We also have to talk about the forced savings fallacy. Many people justify the higher cost of buying by admitting, essentially, that they have no financial self-control. They treat a mortgage as a behavioral crutch. They know that if they rented and saved that extra $400 a month, they wouldn't actually invest it. They would spend it on DoorDash and vacations. So they willingly overpay a bank to force them to build equity. It's an expensive fee to pay for a lack of discipline. Finally, there is the sunk cost of status. We live in a society that judges financial success by visible assets. A landlord's name on a lease is invisible. A house is a tangible monument to your net worth. We are willing to lose money month over month just to signal to our peers, our in-laws, and ourselves that we are successful. But here is the hard truth. Status is expensive. And in 2025, the price of that status is your financial freedom. You are trading liquidity and flexibility for a social badge of honor. The system relies on this emotional vulnerability. It relies on you wanting to own something so badly that you ignore the fact that the bank actually owns you. So if we strip away the ego, the history, and the fear, what is the actual strategic move for right now? How do you survive this hostility without destroying your future? It requires a completely different roadmap. So, where does this leave us? The verdict is sharp and uncomfortable. In the hostile economic landscape of late 2025, homeownership is no longer the default path to wealth. It is a luxury consumption choice. The days of blindly signing a 30-year contract and expecting automatic riches are over. Buying a home to live in is not an investment. It is a liability that might inadvertently become an investment if you hold it long enough and get lucky with the market. If you want to survive this shift, you have to stop acting on emotion and start acting like a hedge fund manager. You need a new strategy. Here are your 3 steps to navigate this economy. Step 1. Calculate your burn rate, not just your monthly payment. Ignore the principal. Compare the pure rent of a property against the unrecoverable costs of owning it. That is the interest, property taxes, insurance, and maintenance. If renting burns less cash than owning burns, renting is the mathematically superior position. Do not let a real estate agent talk you out of simple arithmetic. Step 2. Execute the renter's edge. This is crucial. If you choose to rent, you cannot just spend the savings. You must take that $400 monthly gap and your protected down payment capital and aggressively invest it in a diversified portfolio. If you rent and spend, you lose. If you rent and invest, you will mathematically outpace the homeowner in net worth over the next 5 years. Step 3. Radical patience. Do not buy until you can commit to a 7 to 10-year time horizon. The friction costs of selling and the slow pace of equity building mean that short-term ownership is financial suicide. Wait for the rates to break or for your life to settle down completely. The American dream hasn't died, but it has changed form. It doesn't live in a deed anymore. It lives in your liquidity and your freedom. So I will leave you with this question to debate in the comments. Would you rather look rich with a mortgage you can barely afford, or actually be rich with a portfolio that sets you free? The choice is yours. Class dismissed.